Welcome, everybody. Welcome to our webinar. If you could introduce yourself in the chat while we're waiting, we'd appreciate that. Welcome, everybody, for joining the webinar. We'll get started in a couple of minutes. Meanwhile, if you would like to put in where you're from in the chat, we'd love to hear from you. Thank you for starting to use the chat. Welcome, everybody. If you've just joined, please introduce yourself in the chat. We'll get started in about 1 minute. If you've just joined, welcome to the webinar. If you would like to introduce yourself in the chat, we'd love to hear who you are and where you're calling in from. Okay, I think we can get started. Welcome to the webinar on 10% de minimis and indirect costs, a non-US local partner perspective. This is part of the ASAP series, and ASAP stands for Accelerating Support to Advanced Local Partners. Welcome, and if you've just joined, please put your name and where you're calling from in the chat. Next slide, please. So welcome, everybody. We have a record-breaking registration attendance today. Over 1,200 people have registered for this webinar. We're really grateful that you are all here. Please let us know who you are and where you're calling in from in the chat. I do want to spend a little bit of time on the difference between the Q&A box and the chat. So we will be reading questions only from the Q&A box. You can use a chat box to make comments, to share any responses that you think should be added. But please, we will only be reading from the Q&A box. So please use that for your questions. And today's webinar will be stored on the IntraHealth ASAP website for 30 days. Next slide. So I'd like to spend a little bit of time telling you what ASAP is. So we have a contract with USAID under the Capacity Building and Partnership Office, which is headed by Callie Rothstrong, who has joined us today. And we have been working or will work for 4 years and 9 months. So we started with ASAP 1 and we have continued under ASAP 2. And our primary purpose is to help local partners become prime partners with all the USAID compliance standards and the PEPFAR performance requirements. So we are helping USAID achieve the goal, the PEPFAR goal of 70% of USAID funding going directly to prime partners, and USAID also has a goal for all of their other streams of funding. Next slide. These are the countries where we work. ASAP only works in Africa. We have worked in 18 countries. So here is the list of where we're working. Next slide. Since the beginning of the project, we have helped 126 local organizations in 18 countries. 113 of those are NGOs in Africa, and 13 are local government entities. Next slide. I mentioned before that the webinar will be stored on our website, the IntraHealth.org/ASAP resources website. If you visit that site, you'll see the 92 webinars that we have presented in the past. You can choose which language you would like to listen to if it's been translated. So I hope you visit the website. There's lots of other resources there. Next slide. Here's a list of our upcoming webinars, so stay tuned. July 20th, we have Combating Corruption in Global Health, and that will be presented by Deloitte Consulting and focusing on USAID's new anti-corruption policy. August 17th, Procurement, Property Management, Compliance Issues. August 31st, USAID Financial Policies, Internal Controls and Compliance. And September 28th, USG Rules and Regulations, the Cost Principle. So we have a focus on management, financial management, and compliance through till September. Next slide, please. I also want to promote our communities of practice. These are places where local partners meet together for peer learning. We have them in English, French, and Portuguese. You can look at this link to register. They're very active. They are led by volunteers from the local partners as well as our capacity advisors. And I hope you'll be able to join the next round. Next slide. Today's presenter is Doug Franke, a managing partner with Sustainability Solutions. We also have some USAID resource and listening support from Rami Tiami, Roman Santos, and Callie Ross-Rong. So welcome everybody to the webinar. I'll now hand it over to our presenter, Doug Franke. Thank you.
Great, thank you, Catherine, and welcome everyone. Welcome to this hour and a half, 2 hours webinar that we're going to get the most value out of for all of you. And the focus is on non-US implementing partners. There'll be one later for the USAID focused folks. And yeah, my name is Doug Franke. As Catherine said, I'm the managing partner of Sustainability Solutions. I have about 42 years of working with USAID rules. So I've learned a little bit there in those years, and that's what I'm trying to share with you, to make sure you spend the money correctly, understand the rules, play by the rules. So that's what it's all about. Okay, so here's the agenda for today. We've squeezed quite a bit in. So we're going to talk about, where did this de minimis come from? I mean, it's a term that none of us ever used. No one ever said, honey, I think the potatoes are a bit de minimis, or, I think the book is de minimis. We don't use the term. So we're going to understand, where does that come from? And then how it relates to people confuse that 10% de minimis with NICRAs or negotiated indirect rates, which is another webinar that the ASAP project has done. And then why is there confusion in the field? Confusion between primes and subs and confusion between agencies. We'll cover that. And then calculating the base, which is called the MTDC, or modified total direct costs. We'll do a quick sort of example there of how you would calculate it, implementing partners, when you are proposing to USAID. And then we're going to talk about primes and subs, because here's a teaser alert, spoiler alert, it applies to everyone. So certainly primes and subs, those of you who are prime or subs, you should be getting the 10%, and we'll be talking about that. Okay, then of course we have to invoice USAID. We put our vouchers in. We want that 10%. How do we do it? We got to make sure it's correct. If it's not correct, that's going to be a big audit finding, and that's what you don't want. Okay, and then finally, what are the roles of the implementing partners, the missions, the primes, and the auditors with regards to this 10%? Okay, so it's pretty busy. It'll be full. Throughout, you can ask questions, and we will provide answers about 3 different times. And yeah, as Catherine said, please put the questions in the Q&A box, not in the chat. Okay, so again, I'd like to thank certainly Catherine and the ASAP project. We're a very proud member of that. And then we've got Rami and Ramon from the USAID, the group that really manages indirect costs. And then, of course, Callie, who is the contracting officer for this project. So welcome all, and let's get started. Okay, so we always start with the USAID puzzle because for many of you, when you get your award or you're going to get your award from USAID, it's a bit of a puzzle. It's like you pour the USAID out of the box and here's the jumble. And so our job and your job is to put these pieces together. And those of you who've seen this many times, we always start the puzzle. You can see here, let me put my annotator on. We always start the puzzle, of course, with the four corners, because that's the easiest pieces to find. And so for all of you and for all of us, the four corners for you is your award. Read your award, but any rule to apply to you, the four corners concept, or any rule to apply to you, it must be incorporated in your award. Okay, and this 10% will probably be there. Okay, so this is part of these pieces. And then we're going to pull together, not this, but the webinars that we've done with Catherine and the team, the cost principles, compliance rules and regulations, any additional things. And then finally, the A, of course, would be agency, but for you, it's your audit, complying with and performing your audit. So those would be the pieces that we're going to pull together. Okay, but where did this all start? It started with President Obama. Of course, in 2008, he was elected the first time. And about 3 years later, he started realizing, you know what, I'm hearing a lot of complaints from my team members, which is certainly all of the people, all the accountants all over the federal government and control people, and saying, look, we're totally disjointed. We have too much admin. Okay, so the whole point, President Obama started in 2013. So sorry, 2011 was when he started this change to have what's called uniform guidance. Okay, so he tasked a team called COFAR, the Council on Financial Assistance Reform, led by this guy down here at the bottom, Gilbert Tran at the OMB, and said, Gil, you and the team, Victoria next to him, you guys put together the 8 largest agencies and some other people and come up with a uniform guidance rule that's going to apply to everyone. Okay, and that's what it looks like. And all of you should have this bookmarked in your web browser, www.ecfr, electronic code of federal regulations.gov, and you should have that there. So you can find these rules so you can go straight to the source. Okay, now, when the US government, the federal government makes a rule, they check with each agency. They say, look, guys, you're all different. Are you going to accept these rules as is, or are you going to have some changes? And you'll notice here, out of these 28 agencies, USAID up at the top here, they've had some changes. And other people you may deal with, the State Department, they've had some changes. And Health and Human Services, or CDC for many of you, or NIH, they have some changes. So certainly the uniform guidance is the mother document, but you need to be aware for USAID, also there's some significant changes for you, and you don't want to read your award and talk to your agreement officer or AOR. Okay, so what happened? So 10% de minimis. So this came out, 10% de minimis came out on December 26th, 2013, the day after Christmas, Boxing Day. I'm sure you were all reading your Federal Register, or you may not that day. You were probably getting your child's replacement toy batteries. But regardless, that's the day it came out, December 26th. And this is the first time people had seen it. What is this de minimis? And in here, this is the language that they put in. There's a preface or well, basically, when they put out the uniform guidance, they explain to people what the comments were about the changes and why the COFAR made the decisions they made. And I'm not going to read this to you, but basically the whole guidance starts about subpart F. That's in the cost principles. And if you're taking notes, maybe take a couple of these notes down. That's at 2 CFR 200.414.414F. And that's where it first came out. Okay, what it says is basically, this has changed a little bit, but now it says basically anyone that does not currently have an indirect cost rate can elect to choose this 10% de minimis of MTDC, which we'll talk about. So this is where it came out. Okay, now a lot of people, before this came out, there was a lot of Q&A in the government. There was an earlier version. And people were saying, but hang on, why are you only making it 10? Shouldn't it be 15 or 20? Because later on in this presentation, we're going to see that's the norm. 15 or 20 would be higher. But they went on to say, no, pretty much they said no, because the ability for people to conduct full negotiations, and that means full negotiations to get the NICRA, the negotiated rate. They said, look, we're going to keep it at 10. But the other reason, it said they considered the rate of raising it down 10, but recommended that as an automatic de minimis rate without analysis of actual costs, meaning it's not audited. They're going to keep it at 10. Okay. Simplicity. We're looking for reducing administrative burden. They say 10%. If you don't have the NICRA, you can get the 10% finished. Okay. Now, what does de minimis mean? Okay. I've never heard the term de minimis, de minimis. Oh, that book's de minimis. No one used it. It's a legal term. Okay. And what does it say here? It says basically, so I'm just get this up here for you. Okay. It basically says it's a Latin term. But the whole point is a legal principle, you can read the dot, which allows for matters that are small scale or of insignificant importance to be exempted from a rule or requirement. That rule or requirement would be, how do we recover our indirect costs from the US government or USAID? They said it's small, this is too small, insignificant. Okay, so that's why it means de minimis, and I'd never heard the term, but now you do. You can go on and read these slides later. Okay, but basically, so the rule would be, and that's why we've got Rami and Ramon on, those two gentlemen and their team, those are the guardians, if you will, for USAID of indirect cost rates. And their team is incredibly busy doing this for hundreds and hundreds and hundreds of organizations. And basically the president and the US government, the COFAR guys said, look, there's too much burden already. It will set a threshold at 10%. If you want more than that, you have to go for the indirect cost rate or the NICRA. So if you Google de minimis, because we've never heard of it, so what are we saying here? It's trivial, insignificant, trifling, negligible, okay? Tiny, small. Let's go further. Merriam-Webster, the dictionary that we all love. They look at all these things. Insignificant, Mickey Mouse, paltry, okay? It's just too small to matter. And that's part of the problem. People think it's not too small. So that's why we have problems. Okay, so basically we go on from there, and is it just USAID? No, it's the whole federal government. I was doing my taxes recently, and because interest rates were so low, when I tried to get my form, and here this pops up, and notice what it says. I mean, even the IRS, which tries to get every dollar they can for the government so they can give it to you to spend overseas, it said, no, Doug, your form is too insignificant. Your income is too insignificant. It's de minimis. Okay, so they were serious about reducing. They didn't want the burden for them or for you. Okay, meaning taxes you have to file, indirect cost rates you have to file and give something to your auditors and to the US government. Too small, insignificant. So let's focus on that. Okay, but for who? For who? That, remember, the COFAR, the federal rules, the uniform guidance is for non-federal entities. Okay, so here's who they are. It's the American Indians and Eskimos, our indigenous people, the NGOs out there, your not-for-profits, it's our universities, and it's the state and local governments. Those are the users of 5% of all federal spending. Okay, it's not for us. We're this little dot in the middle here. I'm going to look at that later. It's for the entire $6 trillion that the US government spends. So let's just go to this slide to help break it down. And there's so many different ways to count the budget, but basically there's about 6.3 trillion in total. This slide doesn't show all of it, but then you have to break it down into mandatory, which is not on the slide, but that is like Social Security and other sorts of things. And then the discretionary, and this is where the budget fight is or was in Congress over how do we spend these things. And the big breakdown was between defense, you can see here, which is about 800 billion, and non-defense, which is over here on the right. That's where we are. Okay, and so that was the fight over how are we going to spend this basically 1.7 trillion. And down at the bottom here, you'll see international affairs, which is the foreign operations. That's about 80 billion. And of that, USAID's about 35 billion. So we are just over 0.5% of the total spend that the uniform guidance is about. So it's not about us. Okay, we're an afterthought, we're an asterisk. But obviously we're important to us and important to USAID and important to the inspector generals and so forth. So that's why the rules were made for these guys, but they apply to us as well. Okay. Okay, so here is just a quick snip of the budget that was put out. And you'll see at the bottom there, you'll see that our USAID is about $35 billion. So, 35 billion of the 6 point something trillion is, as I said, 0.5%, or that's sort of the portion that applies. So the rules were made for everyone, but mainly for the people in blue. Okay. So here, what we do is, let's just go here and let's just say, so basically what President Obama was saying is this. He was saying, let's go here. We can get that for you. Just go here. So he's trying to say, look, don't worry about it. You, USAID, don't worry about it. All the other people, implementing partners, auditors, primes and subs, we don't want you to worry about this at all. Okay, so that's where we are. Next, we will see that, let's just kill that. Okay, so next what we're going to say is the not Q&A yet. Okay, we could go to Q&A. Do we have any, Melissa, while we're here so far?
We don't currently have any, well, perhaps we have one rather long question, but I think we perhaps can keep going and then gather more questions. Okay.
So next we talk about how does this 10% de minimis relate to NICRAs? Now, a NICRA is a negotiated indirect cost rate agreement. Okay, so basically I'm going to throw a few more things at you. So here is the 414F that we had talked about. Okay, so here's where it's telling us that was pretty much what was summarized in the federal guidance, but just to take you here, and this is certainly what you all need to have in your reference library. Okay, so what it says here is what I said before. Now, currently, any, including you, non-federal entity, which you are, that does not have a current NICRA, okay, except the American Indian tribes that we talked about, may elect to charge the de minimis. It's your choice. Okay, be careful at maybe different webinars when you're doing your proposal. Make sure you understand indirect costs and what can go in there. But the bottom line is you can get the 10% de minimis if you ask for it. And that goes on to say what you can use indefinitely. Now here, this was added later. This no documentation was added later because a lot of people were confused. But it says, of course, no documentation is required to justify it. Okay, well, okay, now as an auditor, taxpayer, I'm a little bit worried because Doug, you told me earlier it's not audited, and now you're telling me I don't have to document it or justify it. Okay, well, okay, I hear you, but now that's why the alarm bell goes off for all the missions, because they're saying, hang on here. So we're going to talk about a little bit later about these next two sentences about how you should be able to at least justify and understand the difference between direct and indirect costs. But we'll get there. But the bottom line is, remember, not audited, and you don't have to justify it, but you do have to calculate it correctly. Okay, now here's part of the problem. If chosen, this methodology must be used consistently for all federal awards until the time that you choose to negotiate for a rate, which you may do at any time. Okay, well, that's one of the little differences of USAID, because as we're going to see, our USAID friends are too busy and right now. And so what we're going to see is that they have basically delegated the possibility of getting the NICRA. Yeah, let's just be clarified here. Okay, no documentation. So if chosen, this methodology, meaning the 10%, must be used until you choose to negotiate for a rate or a NICRA. Okay, which they can do at any time. And again, that's been devolved down to the missions. And so that's why there's a little bit of not confusion per se, but that's why there is a misunderstanding of how things work within USAID. Remember, this rule applies to the 99.5% of the people out there. If you're a US-based organization, you can apply for that indirect cost rate. Okay, so just briefly, how do we, an indirect cost rate requires sort of 3.5 people to be able to play together nicely. First, the implementing partner has to be able to calculate it, and it is a bit complicated. Of all those pieces that we tried to pull together in the puzzle, the NICRA is the indirect cost rate calculation is one of the more complicated. Okay, so that it does take a lot of time and effort, and you have to be pretty much a pretty serious and structured organization, especially in your financial system, to be able to calculate the NICRA. And next, then you'll have to request. All of us in the field are going to have to request our agreement officer or someone in our mission to be able to receive our request and process it. Okay. And so that is where in the guidelines that we have Ramon and Rami on here, in the guidelines, it says the missions can reach out to the headquarters, if you will, possibly for help. But I know that they are quite inundated, but that certainly is going to be between your agreement officer and your mission and USA and your mission and Washington if they get help. Okay. But your AO that ultimately is the one that's going to decide, yes, we are going to issue you a NICRA or not. Okay, there's I've seen a lot of movement working with a number of missions. I'm seeing a lot of movement. Missions are getting interested in it, making sure the auditors are trained up, making sure the AOs understand it. So it's good. It could and will get there, I believe. Next, the auditors need to be able to weigh in because they're going to be looking at your NICRA calculation if and when you get it. And then finally, the Inspector General, they play an oversight role over the missions and the auditors. So they have, they have sort of an oversight role. And I think we're lucky down here in Southern Africa. We have Robert Mason and his team as the IG, and they do understand NICRAs down here because there are a few groups. Okay, so that has to be in place. Okay, so just in 30 seconds, what is a NICRA? A negotiated between you, IPs, and USAID, a cost rate agreement. And basically, you have to take your general ledger and all your numbers, and you split them, and you extract and get out the bad costs, bad debts, advertising, alcohol. You end up with good allowable costs, and then you have to put those either into an indirect cost pool or you put them into a base. And then that numerator divided by the denominator gives you a percentage, and that will be your provisional rate, it's called. Okay, it's a bit of a complicated course. I'm just trying to say to you right now, it's a calculation that your system has to be able to knock this thing out on a regular basis. Okay, then you apply to USAID, and hopefully they will let you have it. So here is the indirect cost rate, and you can get all of these on USAID.gov, or at the end, I'll give you an email address. You can send it to us, or you ask ASAP. They probably could give it to you as well. But the bottom line is there's a couple documents you'd want to read. And here is the one that's been updated. USAID's got an indirect cost guide, but not just that, every agency has one. Okay, right there. The next one is Department of Labor. They've got one too. So if you're going to have a NICRA guy, he or she should read as many of these guidelines as possible. Okay, so in this guide, though, it goes on to say here, as I mentioned earlier, that's a responsibility to issue these NICRAs for you, foreign organizations, with no Washington awards, is with the mission. Your agreement officer. Okay, now it says that our group here of specialists can help the missions with their requests, but pretty much it's up to your agreement officer. So as I said, there's a number of them around, particularly around Africa, that are capable. So I think we're moving to that. But for now, let's talk about the 10% de minimis. Okay. So why is there confusion about it? And who can get it and use it? Well, there's confusion because the uniform guidance, when it came out, it pretty much said that we're going to transition from where we are as agencies and transition as implementing partners and all the oversight bodies and the auditors. We're going to transition to this uniform guidance, but it certainly wasn't on day one, and it's still not. There's still some differences between agencies and what people do in the field and so forth. Okay, but here, what I'm going to say is, here's the guidance for USAID and any agency. When they create your award, so when USAID creates an award, it must have these items in it, and it specifically states here, item 15, it says you're going to have an indirect cost rate or the de minimis. That's what they're supposed to have, one or the other. And we're going to see this again at the prime and sub discussion as well. Okay, now maybe in the field, and I know, in terms of in the field, USAID maybe has challenges having enough agreement officers in the field at all times. And so maybe depending, they came from a different agency or something else. If someone doesn't have a NICRA, well, they say they should have a NICRA. Well, again, you've just seen that they can't necessarily have a NICRA overseas. But the bottom line is, when you propose to USAID IPs, if you're going to be a prime, you should be stating, we are a foreign organization. I am electing to have my 10% de minimis. Okay, now what happened? Those COFAR guys that I talked about earlier, Gilbert Tran and his team, they put out publications. They put out 3 initially. Initially, I think it was 2013, 2015, 2017. And then they did another one when the uniform guidance changed. And this document is incredibly useful, not just on 10% de minimis, but on many things. So, and what we've done is we've highlighted it for people. So again, either ask ASAP or ask us, and we'll send this to you. But in there, pretty much, they are the go-to people for all of the federal government. Okay, and they're the ones that say, guys, these are the rules, play by the rules. And in there, so here is one of the questions. Okay, does a non-federal entity de minimis need to provide documentation? I said, no. I told you that earlier. The de minimis rate was designed to reduce the burden for small non-federal entities, which is you. I mean, even though you may be getting 5 or 10 or $20 million, that's small on the scale of 6 trillion. Okay, reduce your burden. Okay, you must report it on your CFA or FAS, your fund accountability statement, now known as a CFA, your income statement for your auditors. You have to put it there, but otherwise you don't. So I'll show you where to put it when we get to that part. Okay, this is from the gurus. This is from the guys who set the rules. They've said no. Okay, but now some of the problem is missions still, and I understand why. As an auditor, I understand why they're saying, but hang on. Someone's got a $5 million award and we're going to give them $500,000. We must have some support. No, don't worry, be happy. The US government's decided 10% is low enough that you don't really have to worry about it. Okay, then a number, just to help prepare this, I just went to a couple of other sources to say, look, why is there confusion? And here's a perfect example from the National Council on Nonprofits, and they had Q&A. And people are saying to them, well, you have to prove your costs. Here's a statement. You have to prove your costs to receive the de minimis. And they said, no, that's not correct. OMB stated, it stated here, it's an automatic rate without a review of the cost. We talked about no audits. And basically, I just showed you before, it said, just what the COFAR people said, they say, no, you do not have to justify it. And that's what 414F says as well. Okay, so same thing in the prime and sub situation. Guys, IPs, you need to stand up for your rights, because if you don't get the 10% de minimis, chances are you're going to fail. And USAID doesn't fund you to fail, right? They want you to be successful, but you have to play ball here as well. You've got to know your cost structure. You've got to ask for the right costs. I think I've said to a couple of AOs, I know under contracting, there's cost realism, where USAID looks to say, look, and these guys, are they lowballing to win the contract? Then they're going to ask for a raise, if you will. Same thing should happen with the non-federal entity. Someone should look for a cost realism from have they put enough money in? Do they know these costs are going to be incurred to be a good USAID partner? Okay, so the bottom line is here, there's one source that says it is basically an automatic one. You don't have to justify. Another auditing firm like us, they put out guidance that says basically, in addition to the uniform guidance, no documentation is required. Okay, and a reconciliation to actual cost was not needed. So again, one more time, you don't need to justify it, and you don't have to have it audited. Okay, even our friends at USAID India, we just did training over there recently, and they had a fantastic guy. It was his name, Chuck, I forget his surname. But basically, they put these very useful guidelines out. And here's what USAID says to their own people, right? In India, it says USAID must accept the 10% de minimis without any review. Okay, so I think I've said enough now that's the rule. Our challenge is getting everyone to understand the rule as it is right now. Okay, so just recently on January, so you're saying, but 10%, it sounds high. It's not high. 10% is actually very, very, very fair. So the folks at the Ford Foundation, they recently said, hey, they're going to give a minimum of 20 to 25% to their partners, because they know you can't live with 10%. Okay, not that you can't live with it, but when we talk about, for you, cost allocation a little bit later here, you still have to do some work to cover all of your costs probably. Okay, so they've said here, we're going to get 20, 25%. Okay, and then in our more of our NICRA course, but I pulled the slide from there. So here's just an example. This was a study done in the past by a US auditing firm of people's, how much do they charge? What's their average indirect cost rate? Okay, so for nonprofits, which is you, with the MTDC base, which is you, it will be you, okay, for the 10% de minimis, the average or the mean indirect cost rate was 22.9%. Okay, so the US government should feel pretty comfortable that if the average is 22.9, that giving you 10% is not going to blow the bank and not going to be, you know, they're not giving you a profit or something like that you're going to blow. Okay, so the 10% is good. It's meant to be given. It's reducing everyone's burden. USAID's burden, the auditor's burden, OFM's burden, and of course, the implementing partner. Okay. Now, third time I'm showing you this 414F because this is important. Although it says no documentation is required, the next sentence is important also. So as described in 403, now we're in the cost principles, read your award, read the cost principles. 403 is allowable costs. Okay, so you must charge your costs consistently as either direct or indirect, but you can't double charge those costs or inconsistently charge them as direct or indirect. Okay, now direct and indirect costing is quite complicated, but I'm just exposing you to this because I feel for the missions that they're saying, but these guys are probably double charging us. Okay, so how do we get comfort on that? Okay, because they're still going to be asking you. And so in that indirect cost rate guide that I talked about earlier, you can get it at usaid.gov and just search on indirect costs. In there, they have what we call our cost policy statement guidelines. And this is what all of you should do anyways, okay? It's not a requirement, but to put your mind at ease and to put maybe USAID's mind at ease, and for the AOs that I've talked about, and because we audit a number of you, and we've said to the AOs and the mission saying, look, guys, I know you're uncomfortable about the 10% de minimis, but if these guys have a cost policy statement, at least they understand what a direct and indirect cost is. So I want all of you to do at least this, create your own cost policy statement. And that's just where you understand what type of costs we have and how do we allocate these to USAID and our other donors. Okay, because it's not fair just to charge the USAID. You cannot charge your overhead costs for non-USAID activities to USAID. Okay, the US government's very fair. They will pick up their fair share, but they're not going to pick up their unfair share. Okay, so if you got Gates, Global Fund, EU, DFID, other sorts of donors, they've got to pick up their own fair share. Okay, and that's what the auditors are going to look at. Okay. Okay, so basically, the cost policy statement is what you should do, and it's just how we break down all these type of costs. So it forces you to think. Get your finance guys together and think, how are we going to do this so we can, again, not to justify the 10%, but to put your own minds at ease that you're actually recovering all your costs. Okay, so here's just the typical types of things that would be indirect costs if you could get a NICRA. If you could negotiate a rate, these would automatically go into your indirect cost pool. HR, our overhead for HR, it's an overhead cost. Okay, financial management, that's an overhead cost. Contract, executive, our leadership, those are overhead costs for sure. Carry on, IT, overhead. Legal, of course they're overhead. How do we allocate those costs to our implementing partners? What does the insurance guys do? Right? Maybe that one a little bit more because what are you insuring? But the bottom, rent, space, our building, those are typical overhead costs. But because you can't have the NICRA, you are going to have to direct cost those items. Okay, and that's where that is where I just pulled a couple slides from our other courses. But if you don't have an NICRA, you're going to have to try to allocate some of those costs to your USAID projects. So again, based on the type of activity, you try to create and that's what your cost policy statement would say, is to say, okay, well, I've got my personnel, our HR people, take the second bullet, HR, how do we allocate our HR people? Okay, well, it's illogical to allocate them based on maybe headcount. So one project is 30 people and one project is 60 people, then of course the project with 60 people would absorb more of the overhead of HR. and so forth. So there's a logic and a methodology for the normal types of overheads that you would have to allocate. Occupancy or rent, well, it's based on square footage or meterage. It's logical. So I've got this one floor for this project and 2 floors for that project. Well, each project should pick up its fair share of the rent and so forth. Okay, so now all costs that you charge to the US government and USAID have to be reasonable, allocable, allowable, and supported. Okay, when your auditors go to audit you, they're going to make sure that every dollar you charge to USAID is reasonable, allocable, allowable, supported, or documented. Okay, the one people don't get right frequently is allocability. And that's why we're talking about it now, because allocability is where you're trying to allocate costs between the various projects. Okay, and this sort of relates to the overhead that we've talked about. So here's the actual rule. Okay, it's taken straight out of the uniform guidance. Okay, cost is allocable to a particular cost objective. Okay, in accordance with the, well, I'm not going to get too deep into it, but the bottom line is there's sort of 3 types of costs that you can allocate. One are the direct costs that are incurred specifically for your award. So many of us are PEPFAR, HIV/AIDS. So let's say, okay, we've got people on care and treatment. So our monthly ART, that's specifically for this project. Okay, I've got 1,000 people on care and treatment. So every month I need 1,000 doses of ART. Okay, or we're going to do 100 male circumcisions a month. So the test kits or the circumcision kits, that's for this project. Those are easy costs. That's the but-for concept. But for this project, I would not have incurred the cost. Those are simple. The next 2 are a little bit more complicated. This number 2, so you've got costs that benefit both your USAID award and other awards. And those can be distributed in proportions that can be approximated using a reasonable method, meaning probably calculated. That's where we go back to these things over here. Okay, personnel, I'm allocating it based on headcount. Rent, I'm allocating it based on space. Accounting could be based on funds processed or, depending on the nature of your activities, something like that. Insurance, well, what are we insuring? So I can calculate, great, I've got $1 million worth of drugs in a cold storage house, and that's pretty much where all the insurance money goes. Well, that insurance should go to that project, doing those projects. Okay, so that's the second type of allocability there. It's the third one that most people don't get. Okay, and unfortunately, in the USAID standard provisions, it doesn't make it so clear at M1 that this is going to be an allowable cost as well. Okay, but the whole point is, and this is the US government rule, it's not USAID rule, it's not a foreign rule, it's a US government rule. If a cost is necessary for the overall operations of you, okay, and assignable in part to the award, it is assignable with the principles in this subpart. Okay, this is again, this gets complicated. So let's just go down to D. Before I go there, notice this here though, this B. It basically says, yeah, US government's going to give you the costs, but we're not going to pick up the global fund or Gates or any other costs, right? We're going to pick up our fair share. Okay, so make sure, that's why we talk about that cost allocation policy above. You're going to get a cost policy that says, how do we allocate costs to the other projects? Okay, the auditors aren't going to necessarily look at your 10%. They're going to say, great, you had rent. Well, what did the guys upstairs pay for? The downstairs is our USAID project. Upstairs is global fund. How much did they pick up? Okay, their auditors are going to ask for that. Okay, now this D is where it's driven in again. That's why I color coded it for both here. Okay, so D makes it clear, and this gets complicated. Direct cost allocating principles, and I'm sure Rami and Ramon would understand this way better than I. But the whole point, they're saying it the second time here. Cost benefits 2 or more projects in proportions that can be determined without undue cost or effort, then you should be doing it based on that. Let's get my highlighter going here. Okay, but it's the next one, and here's where they make it crystal clear in audit and recipients. There's too frequently someone tells you you can't charge that. You can't charge your internal controls. You can't charge your lawyer. You can't charge. It says, look, if you must incur the cost to be in business, that's what it said up top. So you do need, I'm going to show you now, before USAID even gives you money, they perform the NUPIS. That's part of the ASAP project, the non-US pre-award survey. The first domain, we look at your organization. We say, are you a legal entity? Or do you have a board? Does the board meet 4 times a year? right? So how can USAID or how can a prime say, you've got to have this to get our money, but then not allow you those costs? Okay, it's just unfair and inconsistent. So that's why I'm saying, for a cost realism point of view, you have to know all of your costs and make sure you're allocating those fairly. Okay, so as I said, if a cost benefits 2 or more projects, your NGO fees, right? Again, your lawyer, your HR expert, but it can't be determined because there's no interrelationship between that person or those activities and the project. A board meets to discuss everything. They may not be discussing USAID 33% of the time. Okay, so the whole point is all those costs that you must incur to be in business, you can still charge and allocate those to your USAID project. Now, on what basis you decide, it should be consistent year to year. I tend to suggest people use the volume. So if my USAID project is $3 million and my global fund is $6 million, global fund picks up 2/3 of these projects, these costs which are difficult to allocate. Okay, I think we might have a few questions now, I hope. Melissa, what do we have?
Actually, Doug, I'll take the questions. I've grouped them into several different buckets. So thank you, everybody, for submitting your questions. The first is a question on language. Will this presentation be done in French? And we have a few comments that non-English speakers and even English speakers are having trouble following the pace of this. So I do want to reiterate that this is recorded and will be on our website, so you can listen to it and pause the slideshow and the presentation when you're listening to it on your own. And that, yes, we will be having the same presentation or the same topic in French and Portuguese. So the next bucket of questions is for you, Doug. It's about approvals. So who approves the 10% de minimis at USAID? If it was not stated in your cooperative agreement or in the pre-award stage, can you later go back and ask for it? Yeah,
a very good question. That's a tough one. So the reality is they should have put it in there. And that's sometimes the problem in the field. As the COFAR anticipated, it's a learning experience. We're going to work our way into compliance. But the rule is they should. And so now all of you IPs know that you should have it. So put it in going forward. Going backwards is a bit tough because, frequently you're funded and you're funded is either for a year or a project. And the missions aren't sitting around with extra bunches of money. They can say, oh, I'm going to find 10%. So in theory, and it gets difficult because in theory, they could move around your award. You could rearrange your budget. But at the end of the day, that money's got to come from somewhere. So chances are, and no one wants to take money out of program. So, it's sort of fairly difficult. Legally, in theory, yes, practically difficult. Now, if you're in a country where you're having a lot of depreciation against your local currency versus the dollar, okay, certainly here in South Africa, the dollar is, the rand's depreciated 20–30%, and your award is going to be in dollars, there's a chance that there will be more local currency left over as time progresses. So you should mention to your AO and AOR, look, I'm sorry I didn't ask for the 10% up front, but now that things are changing, or maybe something's happening with the program and we're not spending it, can you please amend to get the 10% de minimis? I can't guarantee it, but the time to do it is up front. That's both for the prime and a sub. Thank you, Catherine.
Thanks, Doug. That actually was one of the questions a participant had. If you have extra funds available because of the exchange rate, can you then go recalculate the 10%? So you're saying ask for a budget modification. And then lastly, under what circumstance is an IP required to justify the 10% de minimis?
Well, by the rule, never. Okay. But tell that to the mission. I mean, you never bite the hand that feeds you. So that's why up front you may want these discussions. That's why I think, Catherine, you are kindly doing this course for mission people as well. But everyone should play by the same rules. COFAR made it quite clear in their guidance. You're not supposed to. You do not have to justify it. And even when it was Chuck Pope, that was the name I was looking for. Chuck Pope, when he created all those great Indian things, he said, look, missions shouldn't ask for justification. But trust me, when I'll get a quick story here. We had an organization in South Africa where one can get a NICRA. We've got some very switched on and helpful AOs here. And someone said, well, do we want to go for it or not? And, we looked and said, look, if you to this large NGO, like many of you, and so we looked at it and we said, look, your rate, if you calculated it, you could really probably get down to 11% and ask for the NICRA, or you could take the 10%. And you don't have to do anything for it. So the logical answer is go for the 10%, right? I mean, justifying a NICRA, you get audited, your systems have to be incredibly strong. So, just go for the 10%. So you would struggle to get your NICRA down to an 11% rate. Now, the reason people may want to do that is because Global Fund, Gates Foundation, other donors aren't going to give you 20, 30% like the Ford Foundation. Okay, so Catherine, the short answer is you shouldn't have to document it and justify it. And so literally point them to, without putting it in their face, point them to cost principle. Those principles apply to you. 414F, third sentence says no documentation is required. Thank you, Catherine.
Thanks. So the next bucket is on subawards and the flow downs. How does a non-US NGO prime that has elected the 10% de minimis, but has a subawardee with a NICRA rate above the 10% de minimis in its budget? How do you handle that?
Okay, so we will see that. Great question. We will see that. So in 332A, 4, A and B, there it says if a prime has a subrecipient that has a NICRA, they must honor that. That sub or whatever, he or she or they, and they could even be a U.S. prime. Remember, a U.S. organization they've got their NICRA, and now they're going to be a sub. They've earned that NICRA, and you must recognize it. So even though you, the prime, maybe you're a foreign prime, and you're going to get your 10% de minimis, that sub who has the NICRA, whether it's 15, 20, 30, they get that. You have to budget that in, as that goes under the subaward line item. Okay, and you'll see that here. I'll show you that slide. Thank you. Good question. We'll get there.
Okay, and then similar questions are subrecipients to primes. Are they eligible for the 10% de minimis?
Yes, we will see that as well. They are. They're supposed to. As a matter of fact, primes, if you don't give the sub the 10% de minimis, you are deficient. You are non-compliant. Okay, it's a must. There's over 330 musts in your standard provisions, and 23 must nots, but there's about 351 must or must nots. That's one of them. Okay, and we'll go there and we'll see that. So everybody gets the 10% de minimis. Okay. Unless you do direct costing, and that gets complicated, but just assume if you ask for it, you should be able to get it. Very rare circumstances. If the only reason your existence is for the US government, then you should be direct costing everything anyways. That's why, again, it gets complicated, but I did show you that direct cost, that 405D, and that talks about direct costing. But if you must incur a cost to be in business, US government will pick up some share of it. Thank you.
Okay, the next topic is on audits. I know you mentioned this, but is the 10% de minimis auditable, and what supporting documents do you need to show auditors? Okay,
so the 10% is the 10%. That's not the number is given. It's stuck. The question, and we're going to see this, so you're preempting a couple things, but yes. It's not audited. What we audit is that you did the correct calculation of the base, the MTDC. That's what we'll look at. And that's what USAID looks at before you even get your award. They'll look to see that you calculate MTDC correctly, preferably before they give you the 10%. So it's not it's the calculation of the base. That's what we audit. And the prime should be auditing that as well. Okay.
Thanks. And last question for this round of Q&A is a non-US organization allowed to apply for NICRA?
They are. That the rule says they are, but as we see, the team in Washington is so heavily focused on the thousands of US-based organizations. So they have agreed with Missions that if a non-US organization wants the NICRA, They have to reach their agreement officer in the mission, and it may not be he or she, because the chances are there's one person in a mission who may be capable and interested in doing that. So it may not be your AO, but you reach out to your AO and say, dear AO, we believe we're competent. We'd like to apply for the indirect costs. Will you please enable us to do so? And that's where it's between them and the Washington team, possibly if the mission doesn't have the competence to reach out to Washington to get some help. Okay.
Thanks, Doug. That's all for now. We'll catch up on the next round of Q&A with the questions that were just added. And some of these questions will be addressed in Doug's slides.
Super. Thank you, Catherine. Okay, so how do we calculate this base MTDC that we've talked about? So this might be a little bit small. First of all, let's define what is MTDC, modified total direct costs. Okay, why do I highlight 68? In the original uniform guidance, the definitions were numbered from 2 to 99. Okay, and so this was MTDC is number 68. And so for the next 5 years until they did the next many years till they did away with the numbering, people referred to 200.68 as MTDC. And so it's quite a limited explanation. So it goes on to say MTDC means or includes. What is included in this base is all direct salaries and wages. So the people that are actually doing hardcore work on the project. Applicable fringe benefits for those people who are direct. All the materials and supplies for your project. So for us, it's all the reagents and kits and activities. And of course, for farmers, Feed the Future, it's all the seeds and all that stuff to make the project work. It's the services that you have to buy or to use to implement the project. It's the travel, and then only the first $25,000 of each sub-award, regardless of how many years it is, only the first $25,000 is part of the base. That's what we call the sticky part. The 10% is going to stick themselves to all of these costs. Okay, then it goes on to say MTDC specifically excludes equipment, capital expenditures, any building you may be doing, right? Anything brick and mortar, no, you don't get 10% on top of that. Charges for patient care, current topic of discussion. But basically, as of now, patient care, remember, the 99.5% of the people, when they think patient care, it's very different from what we think, especially PEPFAR people. So I'm trying to do some more research on this one. But for now, assume patient care, be careful how you define it, is excluded. Rental costs, no. Why do you get 10% to rent a building? Tuition remission, we don't have this. Scholarships, fellows, that's more universities that have this. And then participant support costs and everything over 25,000 of your subs. That's excluded. Okay, that doesn't say much, right? Because you're saying, but what about? But what about? All these but what abouts made the COFAR people say, look, I'm tired of answering what abouts. And so they put in the third version of the uniform of the guidance Q&A, they put this explanation in. I'm not going to read it to you, but the first part's the question that says, well, hang on, how about this and this and this? They said, no, forget it. The answer is MTDC does not have different ways of calculating. Then it goes on to say, down here where my red dot is, in general, MTDC is total direct costs, excluding those items that we talked about. And that's what you want to do. Start with your total budget, explode it down to the individual line item, explode the 8 items down to 300, and look for, so anything in there that's going to be an allowable cost would be allowable except for equipment, capital expenditure, and so forth. Okay, so make it easy on yourself. That's what President Obama and COFAR wants it. Make it easy. The COFAR guy said, make it easy. Take all your costs and look for those items that have to get excluded, and that is your MTDC base. Okay, so I just show you, we created a quick example for you here. So here, these are all the normal type of costs that many of you are going to have. Of course, we've got salaries and travel and equipment, different types of equipment, and so forth. We're going to have training, and we're going to have a couple subs, and they've all got different budgets and so forth. And then our rent and all our extra stuff. Okay, as other direct costs, our ODCs. Okay, so now all of these costs are allowable because USAID, when you did your proposal to the mission, the OFM team and the evaluators went through and said, yes, okay, we're definitely we're gonna have conferences, so that's allowed. And they've got the subs, that's allowed, got pre-approved, remember, and so forth. Rent, that's allowed. Okay, now you want to calculate your MTDC. So you go and basically you have to do a calculation. I'll just use the other one, that'd be easier. You just say, okay, here's our original budget, and I'm excluding the things that are excluded. Equipment, out. Okay, refurbishment of a clinic, capital expenditures, out. What participant support costs, it's out. Subrecipients, that sub's 110,000. So only the first 25,000 of that is going to be allowable. So 85 is out, 25 is included. Subrecipient B, 45, only 25 is allowable, 20 is out. And of course, the small sub, well, all of it's allowable. Okay, so that's what you have to do. Okay, so let's go back to that other one. So basically, you start with your total direct costs and you identify all those exclusions to get you your true base, the sticky base that the 10% is going to go on top of, and then you add the 10%, and that's what goes in your budget. Okay, so you've already, remember, all of these costs are going to be allowable. It's just you're going to have you got to exclude certain things to do this calculation, and then you're going to add the 10% on top of that, and then your total budget would be 1.610 in this case, and 100. Okay, I know this was quick. But it is, the first couple times you do it, it's complicated. But after that, you learn. That's why COFAR made it so easy by just saying, look, guys, start with total direct costs and then exclude the things that we've just talked about. So that's how one calculates MTDC. And that's how, when you apply for your budget to USAID, you say, here's my total costs, here's my exclusions, I'm excluding these, then I'm adding the 10% de minimis. And there's my total cost. Okay, we love emojis, guys. It shows someone's happy, so keep them coming. Okay, so any questions now? So that was how to calculate it. Okay, and USAID has some good examples for that. Okay, now, Catherine, you asked about the 10% allowance between the prime and the sub. Okay, and remember, it's a federal rule for all agencies. It's not specific to USAID overseas people. The rules for everyone are, the bulk of the people. And they made it quite clear. In your guidance, in the uniform guidance at 332, it talks about the requirements for pass-through entities. That's a prime. Prime is a pass-through entity. Okay, and we have a whole course, as a matter of fact, Catherine, right? One of our webinars is on this. So we're just giving you the highlights of it, of course. And it starts by all pass-through entities must, all primes must make sure that your subaward, make sure that your subaward includes all of the pieces that USAID has said must be basically in the prime award as well. Those 15 items that I referred to earlier, when it said at the 201, what USAID must put in a prime award, effectively, that's what you have to put primes into a sub-award. And so that's what that number one is, right? The federal award identification, all the stuff that, where's the money come from, and many other things. We don't have time to go there. Join Catherine's sub-award course. Okay, then all requirements imposed by the prime. So that's just making sure that the prime has to pass down requirements to the sub to make sure that the consortium as a whole can meet USAID's requirements. Any additional pass-through requirements? So after the prime does the pre-award survey, they may have special award conditions on the sub. But then we go down to 4 here. That's why I said earlier. Okay, so here's where it is. Okay, if an approved federally recognized rate negotiated between the sub and the US, they must give them an approved federally recognized indirect cost rate negotiated between the sub and the US government. If no rate exists, let me just say this in plain English. Okay. Basically, if a sub has a NICRA, as I said earlier, you prime must give them that rate. So as I said, it's for some, like AMREF, for example, in Kenya has a NICRA. Right to Care has one here. Mothers to Mothers, Broadreach. If you've got these people under you here and they have their NICRA, you must give them that because they've already negotiated that rate as fair with USAID. Okay, now, but if they don't have one, which is most of us, 99% of us don't have a NICRA. Okay, so it's going to be either a negotiated rate between the prime and the sub, which most of you are not going to do, or B, the de minimis rate. Either. It's got to be one or the other. Now, this is beyond this course, but it's good for those of you who are primes that want to start helping, one, yourself understand NICRAs, and two, the true cost structure of your subs. You could do this. You know, this basically you're calculating a NICRA, but USAID doesn't have to recognize it. Okay, but you're helping them figure out their cost structure. This is noble. This is a good thing to do. Okay, but the sub may just say, I want my 10% de minimis, and that's what you have to give them. See that? So going back to the top, all pass-through entities must define what they have, and that's actually number 14 in the subrecipient number, but it basically that says either the 10% de minimis or a NICRA. Then it goes on to say, if they have a NICRA, they get it. If they don't, then you can negotiate a rate with them, and that could be higher than the 10%, or they take the 10% de minimis. Finished. Okay. I don't want to go any further, but I'm just highlighting here that we talked about these cost allocation method that we looked at before. Remember, we looked at that 405D. That's color-coded to show you what we talked about earlier. So these things all tie together. Okay, that's what it is, Catherine. They asked for the sub should get this. And that's what the COFAR people said in some of the Q&A. It says, oh, my prime doesn't want to give me the 10%. What should I do? COFAR said, tell the prime they are subject to debarment or not debarment suspension. They are subject to their own determination that they are not being compliant. Okay, so they expect it, and so primes, and think about it. You don't want your subs to fail either. USAID's not giving you money so you can squeeze your subs. So yeah, we'll get more money for us. No, everyone needs a 10%. Trust me, 10% is not a lot of money. Okay, while I'm on here, I've got a captive audience. I just do want to mention that it's important that primes, when you do have subs, you have to make sure that you have access to your subs records. Okay, because you are responsible for the money you pass through to the prime. So not that you're going to audit them, but there's many reasons why you need access to the records. And if I'm your auditor as a prime, right? And if this sub, particularly if this sub is under the $750,000 threshold, they're not going to be audited by anyone. But you, prime, you're still responsible for those subs. So just be careful that you have access to the subs records when you need it. Do you believe them? Yes, but trust but verify. So again, and they're not going to be audited, but you, prime, with small subs will be audited. And what we audit is that you did your job at managing these subs. Okay, so you just make sure in your sub-award agreement, you say to the sub, we have full access to your records. Okay, so now we talked earlier, so that was A, what goes into a sub-award. Now here, basically, the B is the pre-award survey that ASAP has done so many of, and you, primes, are responsible to do this risk assessment. And it is truly a risk assessment. It's a risk assessment of, is this sub going to be able to handle my USAID money? Just like USAID, missions perform these NUPASs, or ASAP does it for the missions. Okay, but basically you must do the same thing there. So you're looking at the risks. Okay, so all I'm highlighting is we talked about some of the domains that Catherine talked about in the pre-award survey. Are the first two that I'm going to talk about are governance, legal and governance. So the people doing the NUPASs have to say, okay, are you organized correctly? Do you have governance? Do you have a board? Do you have internal controls? Well, if we're asking, if USAID is asking you to prove that you have these things in place to give them comfort, you're going to be a good partner, then you're going to incur costs to be in business. This is one of these costs like we talked about, the 405A3. Right? The third cost, you must incur costs to be in business. Many countries, you must have a board. You must have adequate internal controls. Okay, you must be registered for tax. All these things are the structures that U.S. government wants, so they should pay their fair share. Likewise, the second domain, financial controls. Do you have internal controls? Internal control systems. Do you have internal audit? Do you have risk assessments? All of these things you're expected to have. And so let's just say this, everyone, prime and sub, please make sure when you are proposing to USAID that you put your adequate costs in the proposal, right? AID's not trying to short you and squeeze you so we'll get the last penny out of them. No, they're going to fund you to be successful, but that would be certainly an overhead type cost. Okay, it's hard to, internal control systems are for the entire organization, right? The structure, governance, board meetings are for the entire organization. So those are commonly things that people say, well, I'm going to use my 10% de minimis for, and that's fine. But that's why you do that cost policy statement that we talked about. Okay, so how are we doing on time here? I'm just looking at, we started at 2:30, did we? Okay, or whatever, 30. So we're an hour into it. Okay, how do we invoice USAID or the prime, or the 10%? Now, we took that organization that we looked at earlier. And here's where it helps if the people who prepared the proposal certainly get around the table when we're going to start invoicing USAID after the fact. Okay, so remember, now here we're showing October 22. So let's say you applied last year and you got your award in October, and now at the end of October, you are going to be submitting your invoice. Okay, so all of these costs were allowable as a cost if they're reasonable, allocable, allowable, and adequately documented. And so these were in your budget. So here, the first month we did all these costs. Cool, great. It's going to go on our voucher. Now, but how do I get the 10% de minimis? Ooh, now I have to do the calculation. So I'm taking all of these costs that I incurred, then I have to back out the items that are not allowable. Okay, so another way to show it here is maybe more the more detailed example. So salaries, okay, well, let's just move things around here. Salaries, that's going to be included in the base. The travel, yeah, that's included. Because remember, I've exploded my proposal, and now I know everything except these specifically excluded items is going to be allowable. And so then we say, oh, equipment. Okay, well, okay, equipment, and it doesn't matter. Remember, vehicles, you have to get prior approval from your agreement officer to include them, but it's still excluded when it comes time for the MTDC base. So people say, no, the agreement officer approved my vehicle. Yeah, just so you could have it as a direct cost, but that doesn't mean you're going to get the 10% on top of it. And then we refurbish the clinic, and okay, but that's excluded. Then training, well, accommodation, car rental. Car rental is different from building rental. Let's just be clear here. Remember, these are activities and services. And the whole point of the 10% de minimis is it's pretty much, it is covering that 10% goes on top of your activities. And that's pretty much similar to the logic of a NICRA. I mean, if Ramon and Rami wanted to weigh in here, who are way smarter than I am, but the whole point is that the indirect costs are the things that go into the pool over an active base. Your activities, your nurses and doctors and people who are at the coalface doing the 8 hours a day. Those are the salary type people there. Okay, so participant support costs, that one gets excluded. Those are related to basically training costs and things like that for non-employees. That is participant support costs. Okay, then we go into the subrecipients again. So in month one, well, that first guy that was going to get a lot of money, 110, we gave him 30 in the first month. And so the first 25 counts and 5 is out. Subrecipient B got 26,000, 25 is in, 1,000 is out. From then on till the end of the project for the next 5 years, or however long that subaward exists, they're excluded from then forward. Okay, and the subrecipient C, well, they only got 6 that first month, so it's all included. Okay, then we go down to ODCs, and that's where a lot of times there's questions on these because they say, well, hang on, shouldn't that be covered by the 10%? No, your original documentation, when we calculated it earlier, right, we had these things as our direct costs. That's why they're ODCs. And that's why our CAS friends, Rami and Ramon, that's probably where their playground is pretty much when they're doing the NICRA reviews and things like that to make sure there's no double counting. Okay, you only get rent once, either as a direct or indirect cost. That's beyond this course, but that's where when you get to a NICRA, it gets very serious. Okay, but communications costs, allowable. Test kit supplies, allowable. All these are the normal activities of the organization, those all go into the base, the MTDC base. Okay, now think about it. If you did have a NICRA, these wouldn't be other direct costs. Legal fees would be logical to go into the pool. Okay, rent would go into the pool. Okay, so the bottom line is, but each month now, this is what you have to do to justify your extra 10%. So as we see here, we've got 200. So our total bill, you're going to get 291,000 for sure. And then you've done the calculation to get the extra 10% on those allowable costs. Okay, and then you're going to add that 21.9 on top of the 291 to get your 313. Okay, so that's how you do the calculation. Now be careful, because many of you are going to say, well, this is pretty straightforward. So after my subs have maxed out, it's going to be the same thing every month. No, not necessarily. You probably have rent every month, but you don't necessarily buy equipment every month. You may buy it, and then after 2 years, you buy a new vehicle, you buy new computers, or you buy something else, or a clinic needs refurbishing in year 3. So you actually, each month, you have to be careful to go through this. And that's what I'm talking about next, is what you and the mission and the auditors and everyone has to be careful of, is that you've done this calculation correctly. Okay, so that's really where we are now. What are the roles of the implementing partners, the missions, and the primes? Okay, well, that's what I said. So IPs, really, your job starts from your proposal. Okay, and again, I highlight this to the mission when we do training for missions is, if you want your partners to be successful, unfortunately, sometimes you have to help think, I hate to say for them, but you should think with them. Okay, and I would create a list. I mean, we could create a list for you, probably the 8 or 10 things that, unfortunately, the IPs don't know when they're getting their first award, that they're going to incur these costs because they have to. Okay, your yellow book audit is going to cost IPs. Your yellow book audit is going to cost more than your statutory audit. It's a different audit. It's a generally accepted government auditing standards. That's going to cost more than your statutory. You're going to have your main audit for Nigeria or Rwanda or Tanzania, and you're going to have your USAID audit. That costs. If you don't know that, you wouldn't put it in the budget. As we said, you're going to be expected to have adequate internal controls. I mean, the folks, the great group in Washington, Walter and his team are really looking and helping the missions to say, what we need to do risk assessments. And you should do risk assessments, IPs, but that's going to cost. But now, as a prime, if you attend the next ASAP prime and sub webinar, but in there we go into greater detail of primes. You're supposed to make sure that when you do that pre-award survey that we looked at, you need to make sure the subs are going to be competent to handle your stroke USAID's money. Okay, so if they don't do it, you, prime, need to put money into your budget. If you're going to bring on a weak sub that doesn't have the capacity to, can't do all this stuff, you're expected as a prime, which is a huge responsibility, to be able to assist them. And Catherine, I think you want to talk later, you've got under the ASAP project, you've got a helpful handbook that you should go to the ASAP website, and it's this sort of sub-award management that you should be aware of, primes. Okay, so sort of in a roundabout way, the implementing partner starts at the proposal stage, where you have to put in all of your full costing. Okay, so you have to know your costs, and then at that point you do the correct calculation with the correct base. Okay, of course, the role of the mission is to receive the proposal. As I've said, over and above the 10% de minimis calculation, I would like them to start thinking, well, geez, are they totally funding? Are we totally funding them? Because a lot of people were new to the U.S. government thinking, ooh, and they're not going to cover that cost. Oh, we can't charge that. Or someone told us we can't charge that, or we better not charge that. Well, then they're shorting themselves. Okay, so that's why I say, cost realism, the concept of cost realism, but for in an assistance environment where, meaning it's a cooperative agreement recipients, full cost your activities. If USAID thinks you're overcharging, chances are they will ask you that in a discussion. Okay, primes, we've talked about that a little bit. Prime recipients, your job is to, of course, you're going to have either your own NICRA or your own 10% de minimis. I think most of us are non-US organizations. So you yourself will be putting in your budget. In your consortium agreement, you will have sub-awardees. They should all have their own 10% de minimis as part of their sub-award. You don't add their 10% to your 10%, right? Because remember, their sub-award, you're not going to get 10% on top of that, except for the first 25,000. So their sub-award, if they're $1 million sub-awardee, they should have, assume about $100,000 in that, in their sub-award. So if they say, God, I got $1 million of costs, I'm adding my 10%, I've got 1.1 million. So that is your sub-award. They are getting 1.1 million, their 10% is included. Okay. You need to do that. And then primes, as I said, each month you have to review that the sub correctly calculated that MTDC base, which means your subrecipient management team has to be capable of understanding this and on a regular basis. Okay. And then, of course, that gets passed up to the mission. And is a mission going to review your submission to the mission's not going to review your review of the sub. They're going to assume you get it correct. Okay, so you better get it correct, because when audit time comes, if the auditors of your sub say they're over the $750,000 threshold, that subrecipient auditor, who's not going to be your auditor, it's going to be some other auditor, KPMG, PwC, Deloitte, us, someone, BDO, they're going to be reviewing that subrecipient. Okay, if they find the sub miscalculated and they pass that cost up to you, you're going to eat it. You're stuck. You charge USAID for an incorrect amount for your sub. So you're going to have to either go back, you're going to either have to take it out of your funds or somehow expect the sub to pay you back, but it gets tricky and complicated and miserable then. Okay, so make sure your subs understand how to calculate it, and they're only passing up those legitimate costs to you as the prime. And you're only passing on good costs to USAID. Okay, and then finally, auditors, as I said, auditors do not audit the 10% de minimis. We audit the base. We audit that at the sub level or any level, sub or prime level, that the calculation that we just looked at, that you got this calculation correct here. Okay, are they going to do it every month? No, but they'll do it on a test basis. And generally, we would be looking at the first couple months when to see that you got the concept correctly. And then on a random basis, they would be reviewing sub. We probably would do, we'd go to look at, we would segregate your general ledger, look to see when you procured or spent money on disallowed costs. We say, oh, okay, so in year 3, they bought equipment. Great, let's go look to see, oh, in year 3, they bought a new vehicle for $30,000. Let's look to see that month, did they get their correct calculation for the MTDC base? Okay, so that is, that's the high level, everyone. And so now, as we talked about what those roles are, I just want to highlight, to throw a wrench in the work here. We talked about different agencies saying to US government, we want to interpret things differently. Some of you who are PEPFAR partners may have Health and Human Services or CDC funds as their funding agency, which is good. Congratulations. However, they have a different rule. Okay, CDC does not recognize the 10% de minimis for its foreign partners. What they do allow you is they say this is under, and this doesn't even exist on the USAID side. C just says for USAID, it says if an organization is a NICRA, they get it. What this says, it says the negotiated rates, but the same thing, must be accepted by all. But it goes on to say down here under 2. Okay, so what they're saying, if you've got a NICRA, USAID, CDC is going to accept it. However, indirect costs onto foreign organizations, okay, performed outside of the US, which is you, can be paid to support the cost of compliance with federal awards requirements 8% of MTDC. Okay, that's 8%. But notice they don't use the term de minimis. Okay, so here's where things get sticky. And Ramon and Rami, here's basically, this is saying you've got an indirect cost rate of 8%, but this will be audited. This will be supported. Okay, so all I'm saying, when we talk about we talked about the whole concept of uniform guidance, in no way is this uniform. So just be very careful, IPs. I mean, you certainly don't want to turn down 8%, but if your true rate is less than greater than 8%, you need to do that direct costing that we talked about at 405D. Okay, that's where you go. You say, look, these costs I must incur. They are allowable. I'm asserting my rights to have these costs covered. Okay, so that's why, again, CDC, you be careful. USAID, they play by the 10% rule. You should all be getting it. We've talked about that. For CDC, just be very careful there. Okay, that's what we said. So I want to thank you for that. So, I mean, the bottom line is USAID did want you to be happy, and they will certainly, so that's what they want you to be there. They want you administratively burdened, way less, okay? Just be happy, calculate it correctly, and make sure that you only are charging in the base the right things, okay? Again, you can reach out to us, reach out to Catherine, to the ASAP project, but we are certainly going to make sure you get this one right because it's so important. Okay, with that, we're going to take, I think, the final Q&A. What do we have, Catherine? Take it away.
Thanks, Doug. Well, we have a total of 95 questions in the Q&A, and we've answered several of them at the beginning. For participants who've put in a question, please note I've grouped them together so you might not hear your specific question being asked. So the categories, I'll just tell you these before we get started, are on the policies, some questions on defining costs, some questions on subawards, and on NICRA. So in terms of policies, the first question is, I'm a new prime. Which policy do I start with? Is there guidance on how the 10% de minimis is supposed to be used?
Okay, so good question. And so, no, there is no guidance on how it should be used, but conceptually, it is for the overhead costs that you are not recovering some other way. So logically, and it gets a bit complicated because certain types of costs are allowable only as indirect costs. So Rami and Ramon could certainly weigh in here, but the most common reason people have a NICRA is because you can recover your bid and proposal costs. Okay, but they can only ever be recovered as an indirect cost. You can never ODC, other direct costs, bid and proposal costs. So in theory, you could say, well, that's why I'm using my 10% de minimis for bid and proposal costs. But otherwise, Catherine, you shouldn't have to justify it, and you can use it. Normally people would. So a pretty good one right now would be on your risk assessments. Okay, that helps you get adequate internal controls. And it would be it's an acceptable cost because you're meant to manage your risks. Okay, so I would say that getting compliant with maybe a timekeeping system. Okay, how do you do your timekeeping? How do you do your timesheets? And how do you record your direct costs? The most common finding for auditors is people are incorrectly calculating on your timesheet and putting through costs that should be overtime and things like that. So maybe spend time on a salary or procurement or travel policy. So that's where I would spend my 10% de minimis if I wasn't charging those directly. I mean, that's complicated to answer because there's so many things you could spend it on. Thank you.
Okay, and can a non-US NGO have both a 10% de minimis and a NICRA in their cooperative agreement?
Okay, good question. No, you have one or the other. You can't have both. Okay, you would start probably with the 10% de minimis, ask your mission, can we please have a NICRA? At some point, they may say yes. If you are, I'm not going to go back to that slide, but if you're a highly competent organization, they may say, okay, finally, maybe with the help of the folks back in Washington.
Okay, and what happens if USAID discovers that the local NGO overcharged the 10% de minimis and they miscalculated the MTDC and charged above 10% on all costs? What would happen?
That would become a disallowed cost, and yeah, they would just disallow the cost. And you have to be careful there. I will tell you, those State Department, when they put out their awards, they just put 10% of total costs. So they actually are writing into the award an incorrect thing. So if you're getting money from state, be careful, because when your auditors come in, they're going to say, well, it's wrong. So yeah, but USAID is smarter than that, or more, let's just say they play the rules better, but they're going to hold you to the 10%. So you have to get that correct. Otherwise, I would, if I'm an OFM or the AO, I would say you should have known the rules. Sorry, pay back the money.
Okay, and can the 10%, can the de minimis be at a rate below 10%?
It could be, but the rule for that's funny, because the COFAR specifically wrote in that, and for USAID and any agency and missions, they say, you can't force it on the people. Because people may say, well, I'm going to volunteer to do 6% because I really want this award, so I'm willing to go at 6. Okay, they look at that askance because they say, did they really ask that, or were you beating them down to get your budget down below? So I think 10%, from all the work we've ever done, if you are 10% is, as the word says, de minimis, you're definitely going to have 10% of costs that you're not aware of, or as we said, the type of costs that aren't in your award anyway. So the short answer is no, you shouldn't be asking for less than 10, and certainly Prime and Missions can't demand less than 10, and shouldn't go less than 10 morally and ethically.
Okay, and are there cases when the 10% de minimis is requested but disapproved by the Prime or the agreement officer?
Unfortunately, yes. And that's why we say, you got to be careful there. Don't bite the hand that feeds you, but we just load shedding. Hopefully we stay on. But, the rule is they're not supposed to. So in those guidelines that I shared with you for the US agents for not-for-profit agencies, they specifically said, you should highlight to them it's your right to have the 10% de minimis. Show them cost principle 414F and say, I'm not saying I'm standing up for my rights, but in a nice way, you're saying, guys, this is what I'm supposed to get. And, they go so far as to say you should get in writing why they're not letting you have it. Okay, that's playing a little bit hardball, but, hopefully as people learn the rules, they start actually giving everyone the 10%. Okay? I wouldn't take no for an answer easily. I'd say, well, can you explain why? And, I normally suggest implementing partners, sort of play dumb to say, but hang on, I read the rules and it said I'm supposed to get it and I don't have to justify it. So what am I not understanding here? Please explain to me, Prime, what basis you're saying I'm not supposed to get this.
Thanks.
Thank you.
And then can you ask for the 10% de minimis when you are granted a no cost extension?
I wouldn't think so. I mean, when you get your award is the time to get it. I mean, a no cost extension is, I think, way late in the game, if I'm not mistaken. I think, put it this way, if you didn't have it, you can ask at any time. And I think the question is going to be, are there additional funds available? So that would be between the IP and their agreement officer. There's no rule on that. I'm just trying to explain the rules.
Okay, so the next series of questions are on the definitions of some of the costs. So if a portion of a salary is covered by direct billing, can you use the 10% de minimis to cover the rest of the salary, say in one of the management positions of an organization? Sure,
absolutely. Yep. There's no definition on what you are meant to use that 10% for. That's perfectly acceptable. So someone, maybe the not chief of party, maybe the finance manager spends, or M&E. M&E is always a good one, right? So they spend 60% of their time on your project and 40% on some other project, and for some reason that project sort of cancels. Yes, you can use that 10% de minimis to not top up their salary, to pick up the portion that is no longer funded by someone else. Absolutely.
Okay, and for the MTC regarding subawards, is a $25,000 ceiling for the life of the award or the reporting period?
The life of the subaward, well, the life of the prime award, of course, but the subaward as well. So that's why some people try to have a new subaward each year, which is sort of cheating a little bit, but legitimately that's legal. I don't know if you'd want to negotiate a subaward each time, but for every subaward, whether it's 1 year or 5 years, The total period of the subaward, it's only $25,000.
Okay, and a few participant asks, what are participant support costs? And can you please give examples?
Okay, so if I don't want to go into it, but participant support costs are pretty much generally concerned in the training. Go into 2 CFR 200 in the 100 in the A section. That's where all your, and it's, let me just say that it is quite, Catherine, can I go there? We're at the Q&A. I think we've, let me just go there because we have a few more. I've got as much time as you want. Are you happy to spend a few more minutes on this?
Sure.
Let me just go. I've got that open for us. And let's just go there. Okay, so I'm going to reshare and share screen. Here we go. Let's go to here. Let me know if this pops up. Okay, super. Okay, so here is the uniform guidance. I was hoping this might happen. So here it's alphabetical. We're in the, let's go up to the top. Let's drag it up. We're in the section here of, it's alphabetical. So we're in the A section of the uniform guidance. So we're starting up here at AAA. 200.1 definitions. That's where I said it used to be 2 to 99, acquisition and so forth. But now now they have too many definitions. So they just go to alphabetical. So let's drag down to participant support costs. And if you're not familiar with US government terminology, this is really a great dictionary, if you will, because they've consolidated it between all of the agencies. So here's your MTDC right there. We talked about it. So that's where you have it. You can get it there as well. Okay, so let's get down to participant support costs. Here we go. It means direct costs for items such as stipends, subsistence, travel, and registration fees on behalf of participants or trainees, but not employees. Okay, in connection with conferences or training projects. So you're holding a conference and you need people, maybe you're training your capacity building people in a rural area. You need 100 community care workers. So you're going to have a little conference and you're going to hire the venue. But for these people, you're giving them a stipend to get there, maybe some subsistence, maybe a little bit per diem. They got to travel to get them there. You pay for their fee if there's a fee, but that's it. Those things are not included in your base. Okay, they're not really. So again, that's what it is. You can see the definition. So it's basically non-employee costs generally related to training situations.
Thank you. And next question is, how do you define equipment? Is it by value? What else do we need to consider for fixed assets?
What a great question. Let's see if equipment is here. Okay, equipment. Now that would be, guys, you go to your standard provisions for non-US NGOs. That's in your ADS 303 MAB. That would be an attachment. That's attached to your award. Okay, that's the third attachment. It's a schedule. It's the third attachment. A is your schedule, the most important thing in your award. B is basically your program. C is your standard provisions. Okay, so here's what it says. Equipment means tangible, so it's real. Okay, personal property, useful life more than 1 year, or a unit acquisition cost greater than $5,000, or the capitalization that you establish as an entity. So most NGOs that I've seen capitalize their goods at $500 to $1,000. Okay, so depending on how you set your capitalization for your own projects. So do we keep track of our own computers? Yes. Okay, well then you keep track of them for US government. Okay, so depending on, so you start with the lesser of $5,000 or your own policy. That's deemed equipment. Okay, so anything over 5,000 absolutely is equipment. But some things under 5,000 could also be deemed equipment, depending on your own organizational policy. Good question.
Okay, and somebody asked, can you please explain, quote, regardless of period?
Well, what I'm saying is that I think that was related to the subawardee, and a subaward could be for in theory. I can't imagine a subawardee for less than a year. That could probably be better as a fixed amount subaward, but for a subaward could be for, let's assume, anywhere between 1 year and 5 years. So the consortium goes in. I mean, we're a proud member of your consortium, and so we're, I mean, a subcontractor, but you know, a consortium normally sticks together for the period. So it would be normal for a prime with a 5-year award to have subs who are going to be there probably for 5 years. And so what I said is regardless of the period, the first $25,000 that sub has claimed the 10% de minimis on, that's it. They might have $1 million every year. Maybe it's a big, or again, let's say it's a sub awardee, doesn't matter the amount. But the first year, the first time they spend 25, that's it. They get 10% on top of that. They get 2,500 on top of the 25,000, and that's finished. The rest of that agreement, they don't get any more. They get their 10% of everything else, right? Of their salaries, of their people, but they don't get it on the rent. Okay, that's sorry, they don't get the sub-awardee cannot claim it on sorry, let's turn this around. The prime is only going to get the 10% on that first $25,000 of the sub-award. You could have subs and subs, but that gets complicated. So $25,000 on any sub-awardee is the maximum threshold. Finished.
Okay, next question relates to that. What is the rationale for exclusions? Yet these are costs that are incurred by organizations.
Well, you know, it's interesting that the concept of MTDC is way before the 10% de minimis. And the concept is, how hard is it for a prime to write a check or pass money down to a sub? Okay, if I'm writing him a check for $25,000 or $250,000, did I do any more work to write out that check or make that payment for $250,000? No, it's no more work. Managing the sub could be more work, but for managing the sub, you're going to have costs, your own costs for managing the sub, not for giving him the money. Okay, so that's the whole point. The size of the sub, the size of the money you're passing down shouldn't really determine your overhead, what you're going to recover on that sub. So that's been there a long time. People, I don't want to get too deep, but you know, I mean, Rami and Ramon could weigh in here. You know, that's potentially negotiable in a NICRA situation, but not in a 10% de minimis. Okay, that's it. Sorry. You spend it on something else. So that's another reason primes, when we talk about if you're going to manage subs, you need to understand how, that's why you do that pre-award assessment. You need to determine, are they strong or are they weak? And if they're weak, then you need to add money to your budget to strengthen them. Okay, but you're not going to get, that's not what your 10% is for. You're going to have direct costs to manage those subs. Sorry, Catherine, for that long-winded, but you gave me an opening, and I want to make sure primes are managing their subs correctly.
Very good, very good. Okay, next question is a little different. Should the voucher examiner at USAID always calculate the 10% de minimis of every voucher that is being processed?
Well, in theory, if they're doing their job, yes, but I will never say which mission or which people we talk to, but you know, I've unfortunately had someone tell me, a controller once tell me, we don't do that, that's the auditor's job. And I'm thinking, maybe the auditor will catch it, but certainly the auditor's job is not to do the voucher examiner's job. So I would say in the mission, just like when the mission does the NUPIS to figure out, you know, are these people have adequate systems? I certainly would be, I mean, if I was a controller, I would say to my voucher examiners, guys, in the first 3 months, we audit all the vouchers that come in. Then after that, on some sort of test basis. I can't speak for the mission, but that's what I would do if I were the controller.
Okay. Can we use the 10% de minimis when applying for a bank account and then apply for a fixed deposit to generate interest?
Okay, so good question. So bank charges are an allowable cost anyways. You don't need to use the 10% for that. So, I mean, bank fees are bank fees. I mean, historically, if again, Rami and Ramon would jump in here, but historically, you know, the interest on the $500 interest we keep now, you know, what you would use for the bank fees. But But the bottom line is that I would not use my 10% for bank fees. That would be another direct cost. Now, you said for a fixed deposit to earn interest. That was the second half of that question?
Correct.
Okay, so let's just talk about interest. Okay, let's just see here while we're in equipment here. Let's see if we go down to interest. Could be here, might be here. You're allowed to keep the first $500 of interest. Let's see if it might be here. Interest that is in your internal controls. No, there's nothing on interest. Let's see here. Now, okay, interest. The rule. Read your mandatory standard provisions for non-US NGOs. Interest, there's a rule on interest. If you receive your money on an advanced basis, IPs, you are meant to keep those advanced funds in an interest-bearing account if the amount you get is greater than $250,000. Okay, if the amount of interest you may earn from that account is going to be greater than $500. Okay. And you don't have to, you've got Islamic banking. And there's one other one, but the whole bottom line is you should keep your advanced funds in an interest-bearing account, and you get to keep the first $500 of that. So I would not be using my 10% to pay my banking fees. No, you're expected to have that. Okay, go to your standard provision M, required as applicable number 1. Okay, RAAP 1. And you'll find it there. So no, don't spend your money. Don't spend the 10% on banking fees. Unnecessary. Good question. You could, but I think you could find a much better use for it. It's much easier to justify that as a direct cost or an ODC. Okay.
Okay. And this is similar to other questions, but I do want to ask it again. Can board members be remunerated with indirect costs?
Yes, they can be remunerated or as a direct cost as well. If you go to, I'm probably not going to be able to find it here, but while we're here, let's just see. So in compensation, okay, so let's go back. We're in subpart A. Let's go while we're here. Let's go to the guidelines. Let's do it. We got a little bit of time. Let's go there. Okay, chapter 2. So we're going to go down to the cost. I'm not sure if you're following along. Are you following along?
Yes.
Cost principles. Okay, so you go down to 430 compensation, and in there it specifically says 430 is compensation. In here it specifically says that fees for trustees for not-for-profits are allowable. Okay, I might structure to find that here, but it is definitely that's an allowable cost. Fees for board members are allowable for not-for-profits. Okay, so they're allowable, trustees, and their travel costs are allowable. A lot of times, now the question is how much? We're talking about allowability. What is reasonable? And the common rule right now is there should be, you could have 2 hours of preparation time for every hour of sitting board time. So if the board's going to meet for 4 hours, let's say, then that guy, the trustee or director, should be able to charge, reasonable would be 4 hours sitting time and 8 hours of preparation time, or 12 hours. Now, at what rate could be, I think it could be here. Here we go. Compensation to members of nonprofit organizations, trustees, directors, officers, therefore are allowable. Okay. So there you go. That's what is an allowable cost. Okay, good question. Yes, they are. But remember, recipients, I mean, a lot of people want to be directors. It's a good thing to do. And a lot of nonprofits can get directors to sit for free, for gratis. Okay, you may have to pay their trip and things like that, but you should try to find directors who are willing to do it for free. Okay, thanks. Next question, Catherine.
Okay, there are many questions about calculating the modified total direct cost. So some of them are where did they go? How is the modified cost calculated? Tell us if there are some expenses not allowed when calculating the 10% de minimis. And is there a template that we can use for this exercise?
I don't think we've created one for ASAP, but that doesn't mean we couldn't do it. But I think the way to do it is, as I don't want to go back there now, but in the yellow, I'll go back there. That's fine. Just give me a second. Let's go back there. Stop share, reshare. Why not? Let's go back to our presentation here. Okay. As I said about what COFAR wanted us to know is this. Is that sharing?
Yes.
Yellow bit? Okay. So they were tired. That's what this whole question was about. They're saying, oh, but you didn't say this. You didn't say that. And they said, look, they said, stop asking the questions. And that's just where my bubble is now. It said, look, in general, start with the total direct costs, meaning take your entire budget, but all those things have to be allowable. Remember, so, make sure those costs are allowable as well. And you could say reasonable as well. Remember, the prudent person rule, reasonable, be as careful with USAID's money as you would be with your own. That's the prudent person rule. Okay. USAID, we are all prudent with our own money. When we get our paychecks, USAID, the US government says, be as careful with our USAID money as you are with your own. And that's reasonable. Okay. So all the costs in your budget should be reasonable, allocable, allowable. Okay, so that's the whole point. When you submit that budget to USAID, chances are some of those missions do look at it in very great detail. Okay, so they may be adjusting. You're saying, hang on, that salary's too much, or it's not reasonable for you to have X. So whatever your final budget is approved by USAID, that's the one you're going to explode down to every line item and say, if it's approved by USAID, that's potentially MTDC. Then you exclude the equipment, capital expenditures, and so forth. So start with the approved full budget and extract the items that are specifically disallowed or excluded. They're not disallowed, they're excluded. Rent, remember, rent is still going to be allowable as a charge. It just does not attract the 10%. And I know that's a bit, so that's why I'm saying you do this exercise, you start here and you say, great, all my costs here in this example are 1.49. Then I'm going to exclude, and you just go through this exercise here, which you can just take this template and say, great. What I would do is probably just list. Well, there's nothing more I can say. You start with your total approved budget, and just extract the items that are not allowed as 10%.
Can you go to the next slide? That was very helpful.
Maybe
that one, yes.
This sort of summarizes it. Yeah, that would be correct. Yeah. Well, at least these are the items that in this budget are going to be disallowed. Notice it's got participant support costs. Okay, you've got construction. We don't have salaries. Sorry, we don't have subscriptions. We don't have scholarships, fellowships. We don't have patient care costs. But you could probably just add those to this list and search for those in the organizations, in your organization, in your budget. Yes.
Okay, and I like the idea of ASAP creating a template. So thank you for that suggestion.
Yeah.
There's some more questions about why CDC and USAID have different rates, one using 8, one using 10, but I think you answered that. Do you want to say anything more about that?
No, it's just, it's the whole point about uniform guidance is, it works for the federal government if everybody plays by the same rules. And, unfortunately, CDC is Health and Human Services, which is the agency level. Health and Human Services, the largest federal agency, spends 1.4 trillion. So they're the biggest agency, and 99.9% of their $1 trillion is spent in the states. So it's a domestic agency. Every health, every state has, all the hospitals and everything. So they're thinking domestic, 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 domestic. Okay. Unfortunately, they came overseas on the back of PEPFAR and have expanded, but their rule set hasn't expanded. And so they're thinking domestic. Okay, that's why the 10% de minimis From them, if you're in the US, you get it because you can get a NICRA. But overseas, and I don't know why, and it's not fair to say, I shouldn't speak on behalf of them, but they don't get that that the de minimis is not a profit, that an overhead is not a profit. And so they limit it to that. And unfortunately, as I've just said, it's not, it will be reviewed by your auditor. So, and they actually had to go through some very complicated rulemaking. So they actually had to change the rules. That's why when you look at that, let's just go there, right? This actually was a rule that they had to go into the regs and change them to get this added. Okay, this doesn't exist on the USAID side. There is no C. There's C1. That's it. There's no 2 and 3. Okay, so the bottom line is, as a foreign organization, you're not going to get the 10%. You're going to get the 8%, and it will be reviewed. Now, unfortunately, Catherine, this makes it a huge headache. Also, I mean, I hate to say this, but USAID CDC is not even recognizing NICRAs of foreign organizations. So for the AMREFs, Right to Cares, Mothers, Broad Reaches, they're not even accepting this here. That's the rule. The negotiated rate must be accepted by all agencies, but they're not playing by that rule. Okay, so all I'm saying is, if you're going to take CDC money, definitely do what we talked about, do that cost policy statement and be able to justify. What you want to do for CDC, let's go back there. You want to be able to go do this. Go to 405, allocable costs, and explain. These costs, my rent is allocated between us and the global fund upstairs. My board, I have to have a board. It's a requirement of the US government. I have to have controls. I'm charging these as other direct costs. Okay. And if they're not going to give them to you, you really should think twice about accepting that money, because USAID is not going to pick up CDC project costs. Okay. So, and it's a bit beyond this course now, but you really need to understand your true cost structure, because if your cost structure is 10%, for you to take an award that doesn't give you 10% from, like, let's just say the Elton John Foundation or the Oprah Winfrey, they say, no, we'll only pay for direct costs. You're harming yourself unless you've got a deep pockets or a big benefactor to pick up those costs. No one's going to pick up the costs. USAID's not going to pick those up. Okay, so that's my CDC speech, right? Demand that you are able to cover these costs as per this. When you do your CDC proposal, you go right to here. When you justify your costs, you justify it in words and in numbers. You justify it this way. You say, cost principles allow me to have it. I would use this here, 405D. Use this one here to say, look, I've got to have a board. I'm charging it as another direct cost. And that they really have no basis to fight you on that. I'll leave it at that. We do want CDC.
There's a follow-up question about board members. So, I think there's a lot of interest in this. So based on your answer, so the remuneration of the board can only be for hours of meetings and preparations. Is that correct? So is it only for prep?
No, all I'm saying is that is normally, I'm saying how much, because sometimes you need a milestone to say, well, what is fair for a board member? Okay, so a board member, so the whole point is board members are meant to be prepared for board meetings. And therefore, a rule of thumb is, if you're going to attend a board meeting of X hours, the whole point is for every hour of sitting time where the board sits and talks, they should be prepared. And an average of 2 hours per an hour of board time is deemed to be pretty standard, pretty normal. I mean, you're not going to have a board member who draws a salary as a non-executive. Well, put it this way, you would probably, you'd want that prior approved by your agreement officer if it was going to be beyond what I would call reasonable. What I'm saying is reasonable, 2 hours of prep for every hour of board. So if we have a board meeting every quarter, which is probably pretty normal, and your board meets for a day, then I would say 2 days of preparation would be reasonable for that guy to charge. Now the question is, what's the rate? What does he or she do? If they're, there's no standard on board fees, but they shouldn't be, I would think, more than a couple $100 an hour for sure. That's why you get those things prior approved. So if you're taking notes, right, look at cost principle 407. Let's just go there. Hey, while we're here, let's go there. So let's get back into our here. And let me know if that comes up. Is it up again? Are we sharing the cost? Are we sharing the uniform guidance now?
Yes.
Okay. Let's see if we can't get that. How do we get this to work now? Okay, let's go up to 407. This is the beautiful cost, the beautiful cost principle that allows you to have certainty. Okay, and it's this same thing as in mandatory standard provision number M1, where USAID puts it out there right up front. And it's standard provision M1 or here 407 prior approval. Okay, it says under any award, the reasonableness and allocability of costs may not be known. Board fees, what's reasonable, what's allocable? So in order to avoid disallowance, you're supposed to reach out to for you, it's the agreement officer. Okay, here is where Ramon and Rami would fit in there. Here, prior approval would be for the guys who approve the indirect cost rates. It would be your overhead guys. But for us, we reach out to our agreement officer, and they will tell us whether they think it's reasonable or allocable to charge your award for that. So IPs, you need to justify it. Okay, so while we're here, so again, wearing my auditor hat, right? If I'm auditing you and I'm saying, hey, why don't you try these board fees? And you say, no, Doug, we reached out to the AO and she said it's allowable, and here's the email. Done. I stop auditing. If the agreement officer said it's reasonable and allocable, then they made their determination. Okay, but if they didn't, then what? Okay, so now it comes audit time, and I'm saying, well, I don't know. The auditor is the ultimate arbiter of reasonableness. If they don't think it's reasonable, we highlight it, and then you're going to have to prove it to the mission. So the whole point is this is a beautiful thing, and that's why I read standard provision number 1C, MSP 1C. It says the exact same thing. If you're not sure, ask up front. And what I've talked to a couple of AOs about this also, when you're doing your budget, well, you should add a column, even if USAID doesn't give you the column, add a column in your spreadsheet to identify that which of your costs that you're trying to claim has a cost principle, right? There's 56 cost principles down under 420, starting at 420 that say specifically bad debts not allowable, alcohol not allowable, but there are many compensation. You just saw that it is allowable. And so you highlight, dear evaluation team, I'm highlighting that compensation is allowable at 430. And if you want to charge that board fee, take them to the chapter and verse where you're saying for it. Okay, where there's not a specific cost principle. Okay, then that's where you invoke this. You say, dear AO, we want to include something that's not in the cost principles. Can we have your approval? That's the time to do it up front, because that shows the evaluation team two things. One, you know the cost principles, and two, you've bothered to go to the extent to ask them for their specific approval. To me, that says you probably are, that shows at least some competence to be a good partner. Okay, now while we're here, please note all of these items under 407, there's 26 of these, all of these things need specific prior approval from your AO. Okay, so when you do the other course where Catherine talked about on compliance, some of these will be covered there. But this is the stuff that will be in your work. Cost share matching, right? Cost share, prior approval. What do you do with the program income? What method do you use? And so forth. Equipment, we talked about prior approval. And so all of these things here, most of these 400s are in the cost principles that you will be, that when you study your cost principles, you'll know that you have to ask for these things from the AO. Okay, sorry about that long-winded, Catherine, but I had the chance, so.
Thanks. We have a few more questions. One is, can you please elaborate on the difference between A-133 subrecipient and non-A-133 subrecipient?
Okay, good question. So A-133 is also known as the Single Audit Act, okay? A-133. And so basically, the A-133 applies to US-based organizations, okay? it does not apply to non-US based organizations. A133 on page 1, number 4 specifically says this does not apply. The Single Audit Act does not apply to non-US organizations. Okay, I sat in Gil Tran's office 20 years ago and asked him, Gil, why? He's the father of the A133. I said, Gil, why doesn't it apply overseas? Because overseas auditors, it would make sense. And he explained why it doesn't. So assume it doesn't. Okay, what does apply is the yellow book, the generally accepted government auditing standards. That's what all the foreign auditors, that's what we teach them. The yellow book is the foundation for the Single Audit Act. Okay, but it's not the same thing. So A133 is a level above the yellow book. So what all we get overseas, we get a audit conducted in accordance with the yellow book, generally accepted government auditing standards. Okay, the guidance there, USAID guidance, ADS 591 MAA, which is being revised as we speak. Okay, so there's your guidelines. And each mission will give you, a guideline to negotiate with your auditors on how to perform that audit. Okay, so that's the confusion, Catherine. And when I talk to the guys in Washington, if I could change one thing, I would change the standard provisions, which says, because remember, the prime has to pass down to the subs, the standard provision. And in there, it sort of indicates that the subaward, that the sub has to be audited in accordance with 2 CFR 200.500, which actually isn't correct. Okay, so the bottom line is all of us overseas get the yellow book audit, which in many of your countries, USAID has they've just created brand new lists of competent auditors. Okay, so that's the short. People use the term A133, and we foreign auditors know what they mean. We know what they need, but we don't tell them they're getting the terminology wrong. Okay, I mean, it's not. I don't want to go to different now. I don't want to jump into different presentations to find it. But I taught the A133 for the AICPA for a few years, and the most useful concept I got out of that course was how to describe what I just explained to you. And they explained it. It's like 3 layers of a birthday cake. Okay, the bottom layer is meaning you are a competent auditor in whichever jurisdiction you're auditing. So if you're in South Africa or Nigeria or Tanzania or whatever, if you're a member of that institute, then you have the fundamentals to do auditing for the US government. On top of that, the second layer is the yellow book, or the generally accepted government auditing standards. So that assumes it's not a different way of auditing. It's a different way of conceiving. How are we going to present this to the reader, the agreement officer? So those fundamentals exist. The fundamentals, if you are an auditor in Tanzania, USAID Tanzania has found you, and they've said you've agreed you're going to do a yellow book audit and follow these rules on what is a finding and how to prepare the CFA and all this. That is the yellow book audit. That's it. Competent auditors performing a yellow book audit. The layer on top of that is the A133. Okay, but it's not. It doesn't go both ways. We have competent auditors who've been approved by USAID. They're on the list. That's all you need. And we know what to give you. And that is what USAID is going to receive. And that's what they're going to accept. It's called a yellow book audit, but not an A133 audit. You got the email. You can ask me later on. But hopefully that was enough, Catherine, for the A133.
Thank you. One participant has had the experience of requesting 10% de minimis from their prime, and they were told they must go hire consultants and calculate the cost and then submit it. So could you please clarify who is responsible for calculating? Is the prime responsible?
No, so when you say go higher, that could mean a few things. I'm assuming I'm not assuming that the prime wants them to have more, but possibly. Remember when I looked at 332 4 1, and I can go back there. Let me just go back there. Sorry, let's go back there. Let's do the new share. Let's go here, share. Okay, let's get down to subrecipients. Is that showing up?
Yes.
Okay, my machine has to catch up here. Okay, so in 332A, it says what the prime must put into the sub award. Okay, let's get out of there. Okay, here it is. Pass-through requirements for primes. All primes must. There's eight of these. And Catherine, maybe we run the run this one again for all these people, so they have the chance to get it again. It's up to you.
Yes,
Okay, so A, prime must make sure it is in the identification, as I said, number 14 says effectively what 4 says. Okay, they must include an approved recognized rate if it exists. So again, AMREF or Broadreach or Mothers to Mothers or Right to Care, they have a NICRA given to them by USAID Washington or USAID South Africa or Kenya, and they have the prime has to recognize that award. If no rate exists, the prime must determine what is appropriate in collaboration with the sub. But it's going to be either this negotiation that prime might be talking about, or the 10% de minimis. So the way he described it, that prime might be saying, hang on, maybe 10% is not enough. Why don't you and why don't we, the prime and you, discuss and negotiate your actual rate? And if you have that opportunity, both as a prime and a sub, I highly recommend you do that. You can make sure you put the time in your budget, but because you're going to spend time doing this. But there's no better learning experience for a prime and a sub than learning your indirect cost structure. Okay, so I hope that answered it. But the 10% is the minimum. Now, I don't want that prime to go say, no, justify the 10%. That would be wrong. You don't have to justify it. You get the 10% automatically. But if you're going to negotiate for higher, if you, the prime and the sub, are going to negotiate higher than that, yes, then you will have to do your cost policy statement. You will have to sort of formalize your cost structure, which I think is a good thing. Okay.
Okay, we have a few questions, very interesting questions on the changes within an award. So when you have a budget modification and say you get additional funding, and some of this funding will affect your indirect, do you then use this opportunity to recalculate the 10% de minimis?
I would say yes. Definitely, when you're getting new money, you should get the appropriate additional new money that goes with it, the additional 10%. Yeah, for sure. No reason not to. I mean, the mission should want to give you your fair share. So yes, I would say.
Okay, and this is actually the last topic for questions. So it's on tracking. How do you track the costs for the 10% as you're implementing? And what if you spent less? What if you have less than 10%? Can you apply for more funding? More for the 10%.
Oh, okay. I mean, tracking, you don't need to track it because you don't need to justify what you're using it for. Most people do use it for program related expenses. And it would be good if you did. Not that you have to show it, but I mean, conceptually, that's what it's for. But yeah, there's no documentation for it. But that's the theory. Now, of course, you've got accounting systems that you have to have probably a use for it. So I as an auditor would like to see. I'm not going to ask you because I don't have the right. But it would be good if you could show me, oh, we use it for board fees or internal controls or our lawyer or whatever else. Okay, so Catherine, sorry, explain it again because that answered, I don't think answered it, but I wanted to get that in there. So ask it again.
So it's a two-part question. So one question is, how do you track the 10% de minimis? So you've requested it, you've done your modified total direct costing. Yeah. But then as you're using the money, how do you track it? And then when you're tracking it and you realize you've undercalculated, are you able to recover the funding gap?
No, the calculate. So there's the applying for it and there's the spending it. So when you're applying for it, you want to get that right. You don't want to underestimate. You don't put it this way. If you start with your total budget right? And then you're only excluding things that are not allowed. Well, then you're going to have calculated the correctly. You're going to get it. Now, again, each month when you're spending all of your money, you're calculating that 10% each month, and you're getting that correct into your organization. When you're spending it, there's no, you don't have to as I said, you don't need to justify it. So I'm not saying you don't need to control it, but in theory, those become unrestricted funds when you receive them. As long as you've incurred the USAID, in our example, the USAID allowable, reasonable, allocable base cost. You've incurred the base, let's say it's $100, right? You've incurred $100 salary for a nurse, and you recover the 10% on top of that nurse. That is now your money, okay? So I, as an auditor, and the mission should not be asking you that's the whole point. It said it 3 times, no documentation is required. And COFAR said it themselves quite explicitly, it's not auditable. I will not, as an auditor, I'm not going to ask you, what did you do with that money? I shouldn't, nor should the mission.
Okay, on the converse, and again, I think it's just good for repeating, what if you go above the 10% de minimis?
Well, when you say go above, if you
when your expenditures for the 10% de minimis are above the amount you originally calculated for USAID.
Sorry, that's it's again, unless you're going to get new budgeted money, that is sort of your problem. That's a great question, Catherine, because that's why you need to that's why the IPs need to understand their cost structure. They shouldn't. That should never happen. They should understand the cost structure. They should do that cost policy statement. And if their actual costs are going to be, as you say, greater than 10%, they should be charging those as other direct costs or as direct costs. Okay, as I said, USAID's not underfunding anybody, but you have to know to ask for it. So if it's a legitimate cost, it's reasonable, allocable, allowable, and you can, when you say allocable, you can say it's a direct cost, right? I've got 100 test kits, direct cost. I've got rent. I'm allocating that between me and the global fund based on space utilization. That's an allowable cost. It's the third one. I've got a board that I'm going to try to charge. Well, that's the common basis that people balk at. They say, well, why? How can you charge board fees? We don't pay for board fees. That's what they say. But actually, if you highlight that 405 that I showed you, if you highlight, let's go back to that. You highlight this 405 eligible. That's what we're talking about here. This blue one. A board is necessary for the operation of the organization. They will pay for it. You just have to justify it. They should pay for it. Let's just say that. Or ask them to explain why it's not allowable. Okay, and Catherine, that's probably going to happen more in a prime and a sub situation than a mission not allowing a cost that the client or the implementing partner is specifically highlighting this concept here. Then you use the logic like, hang on, you just did the NUPIS on us, and you asked us, do we have a board? And we prove that we do. And so why did you ask us if we have a board if you don't require we have one? We have it. Here's your fair share. That's why I said generally the volume. I've never had a client say USAID rejected my basis if, as our example was, make it easy for accounting. My board fees are $1,000, and I've got my USAID project spends $1 million. And the global fund spends $2 million. So I'm going to charge that $1,066 to the global fund, $34 to USAID. Just allocate it based on that. Your usage to me is a fair allocation method, consistently applied year to year.
Okay, and the last question is a good one for you to summarize the understanding this person has. How do I register for the 10% de minimis as a local NGO in Ghana? So register
for the 10% de minimis.
Right.
Well, if you don't have to register when you are an implementing partner, you register when you do your first initial application. I would say that's. I mean, you asked a question earlier. what happens now? People wake up and say, oh, I didn't know I could get that. That's what I'm saying. It's difficult to go backwards. And you can ask the mission, and they may, I'm not saying they're going to have extra money, but but possibly, as we said, maybe through the depreciation of the local currency versus the dollar, maybe that's where they can find it. But that's a tough one. I mean, you ask AOs, they say there's no pot of money. I'm not sitting on money, and especially PEPFAR money, right? These are one-year monies, so it's even more difficult under PEPFAR to find extra money. So I wish there was an easier answer than just ask, but the best time to do it is when you're asking for the money, and the mission should give it to you.
Hello?
Okay, well, I'll just add to that it's been our experience that missions would like to pay for the 10%, but they themselves do not have it in their current budget. So all the advocacy we can do for including this in your next country operational plan budgets or your next awards is very important, but their budgets are finite, and I've heard a few incidences where they would love to, but they simply don't have the money right now.
Yeah.
So
Catherine,
thank you, Doug. Oh, go ahead.
Okay, yeah. Just going to say, we do some training inside missions, and they frequently want to do it with their own team members, and that's fine. And one of the missions, we really had a long discussion on this, and so we had agreement officers on one side, and you had basically the program people on the other side. And this question sort of comes up: what do we do? And the actual legal rule is the recipient has the right to it, but chances are the money's got to come from somewhere, and no one wants to take money out of the program. But logically, that's the only place it could come from, because if they fully costed their operations and now you need more, the only place it could come from is cutting. So we have 1,000 people on care and treatment, and then the NGO asks for 1 or 10%. And so no one feels comfortable saying, okay, we'll only serve 900 patients or something like that. So it's an uncomfortable situation that can be prevented going forward by asking up front. Right? I mean, trying to cut the program, no one likes to do that, and including the IP. So okay, well, that's ending on not the high note, but okay, well, guys, I love.
Can you just one more thing? Could you go to that slide with the next webinars coming up, because you have a wonderful series and people have asked some questions which are not directly related to this topic. And so I just want to encourage, there you go, encourage people to join these other webinars that we have coming up. So the next one is on combating corruption in global health. So that's on USAID's new anti-corruption policy. And Doug, you will be presenting again on August 17th, August 31st, and September 28th. So please come back and join us. Thank you, Doug, so much for this excellent webinar. Your insight and your knowledge is greatly valued by all the local participants, and shows in all the questions that we got. And so the conversation will continue. So thank you so much, Doug.
You're welcome. Thank you. And thank you, USAID as well. Okay. Bye all.
Thank you. Thank you, USAID. Thank you, participants, for joining. See you next time.